Okay, something is happening to my recordings, but anyway, let's continue. Okay, so we're just discussing the ordinary break-even analysis. We said it's also called the cost volume profit analysis, and we're just analyzing the effects of on future profit of changes in fixed cost, variable cost, selling price, and the quantity. So for this one, simply, really what we need to know here is how do we calculate the break-even point both in units and also in dollars. Then the target profit, how do you calculate it to say, okay, so what is the level of activity that we need to attain in order to get this level of profit, okay? And then the margin of safety. So for ordinary break-even point analysis, that's what you need to know. Okay, so just as an overview, we have this test of understanding 2. We have a company manufactures products as the following data are available. So we have selling price is 100 per unit, then variable cost is 60 per unit, then fixed cost is 250 per unit. The company budgets to produce 12,000 units in the next period. Okay, so the requirement is calculate the break-even point both expressed in units and also expressed in dollars. Okay, so that's our requirement number 1. Then number 2 is saying the level of activity required to generate a profit of 90, then the margin of safety. That's basically what they ask on ordinary break-even point. So answering question number 1, we are saying the break-even that we want here, we know that break-even point is just simple. It's just your fixed costs divided by contribution. In this case, our fixed costs, we are told that's the 250,000. Then if we divide this by contribution is just selling price minus variable cost. So in this case, it will be 40. Okay, so our value, our break-even point in units here becomes 6250. Okay, then we are required to calculate the level of activity required to generate a profit of 90. So the formula is just simple. We just say fixed cost, then we add the target profit. In this case, it's 90,000. Then we divide by contribution. We divide by contribution. Okay, so that is 40. So this one will be expressing that target, the level of activity in units. If we are required to express the level of activity in dollars, then we have to divide by contribution to sales ratio, which is 40/100. The same applies with the break-even point. If you are required to calculate it in units, in dollars, then instead of multiplying by the contribution, we rather multiply by the contribution to sales ratio. Okay, that is basically it. Then where's my eraser? Okay, then the margin of safety is just simple by definition. We are saying is the amounts, the amount by which profit is allowed to fall before a loss is made. So we are saying we have a level of activity of $12,000, which 12,000 units, which is this one. But then we calculated our break-even to be 6250. So the difference between this total level of activity and our break-even point becomes our margin of safety. Okay, so we are saying margin of safety is the amount by which profit is allowed to fall before a loss is made. So this one you'll be expressing your margin of safety in units. Okay, so in dollars, it will be the 12,000 in percentages minus 6,250, then divided by 12,000. This one will be expressing as a percentage. So you might be required to calculate a margin of safety in units you just use this formula, 12,000 minus 6,250. Then if you are required to calculate it in percentages, then you say the difference here, then you divide by 12,000. So that is how you could calculate the margin of safety. Then using a graph paper, draw a profit volume chart for scenario one. Scenario one, that's what we're calculating. Then also scenario two, using the graph above. Okay, before we go to scenario two, I'm not going to really draw the break-even chart here, but maybe it's actually there on the second slide. So as you can see, this is the graphical representation of this one is not the ordinary break-even point that, you know, this one is a profit volume chart. Okay, you know that the ordinary break-even graph, it will have this one, then we have total cost, this one will be total revenue, then we'll be having our fixed cost here, then we have our total cost here, then this one becomes our break-even point in dollars and also in sales, in units. But then we have another type of break-even point analysis that we call the profit volume chart. Let me just admit someone who is okay, looks like someone wanted to. Okay, so the profit volume chart, it won't have those other lines. We only have a single line that depicts at any point in time our profit and also the level of activity. So here it will start, so this side, the side below the x-axis, this one will represent losses. Okay, this one will be the losses and this one will be the profits. Okay, that means the x-axis, whenever this line is going to cross the x-axis, that's our break-even point. Okay, this is, so if you are going to draw these graphs, you should make sure that you understand whether you are going to draw the ordinary break-even graph, or you are required to draw this profit volume chart. Sometimes they also require you to draw what they call contribution graph. So the contribution graph is simple to draw. It's just like is the ordinary graph, the break-even point graph, but then instead of constructing the fixed cost line, you actually don't put it, you rather put the variable cost line, then here you put the total cost line, total cost, then you put the total revenue. Okay, so what's the point of constructing the contribution chart? This one enables us to actually see the contribution. You can actually read the contribution directly on the chart. So what is contribution? Contribution is what? Contribution is our total revenue, which is this line, then less our variable cost, which is this line. So the difference between these two lines becomes our contribution. So you can actually read directly the contribution from the graph. Okay, that was just an overview of the ordinary break-even point. My concern today is actually to cover the multi-product break-even analysis. When you are given a break-even analysis for multi-products, what do you do? How do you calculate the break-even point? How do you calculate the required level of activity to attain a certain level of profits? How do you calculate, how do you actually depict it on a graph? Because as you can see, there was a question, was it last year or that other year? There was a question on the last question. Which paper was this one? Was it 2019? This was 2019 December. There was the last question here. Okay. This last question seems as if we had multiple products here, so it might come or it might not come. So I just wanted to highlight how you can go about it here. We had our main products, we had B, C, D, and E. We had 4 products. And then the requirement here, they're saying explain the meaning of the values shown as points A, B on the chart. So we have A, which is this point. Then we have B, which is this point. So you will require to read what those points mean, then those other requirements. Okay, so that is actually the question that triggered me to actually conduct this session. Okay, so what do we do in when we have mod products? Okay, so the basic break-even model can also be satisfactorily used for a business operation with only one product. However, most companies sell a range of different products, and the model is to be adapted when one is considering a business operation. So what we do actually under mod products is almost the same to what we do uh, when doing the ordinary break-even point, but then instead of dividing, like when you are calculating the break-even point, isn't we say fixed cost divided by contribution, but under multiple products, instead of saying divided by contribution, you rather divide it by the weighted average contribution margin or the weighted average contribution to sales ratio. And then how do we calculate that contributed? So what actually changes under multi products is that denominator, the contribution. Instead of saying contribution, we say divided by weighted average contribution to sales ratio. Even when you are calculating the target activity for a certain level of profit, you also divide it by that weighted average contribution to sales ratio. And how do we calculate it, the weighted average contribution to sales ratio? We say total contribution divided by total revenue. That is how we calculate the average contribution to sales ratio. Okay, then the break-even point, we say it will be the fixed cost divided by the weighted average contribution to sales ratio. So you don't calculate the break-even point for each and every single product, but rather you calculate the combined break-even point when you have multiple products. Okay, so let's try an example. Here we are told that a company A produces product X and Y. Fixed overheads cost amount to 200,000 every year. The following budget information is available for both products for next year. So product X and product Y. Selling price were 50, 60, then variable cost were 30, 45, contribution per unit 20, 15. Budget sales with 20,000 units and 10,000 units. So we are required to calculate the break-even point. Okay. So the break-even point, we say it will be the fixed cost divided by the weighted average contribution margin or the weighted average contribution to sales ratio. And how do we calculate the weighted average contribution to sales ratio? We have to first calculate the total contribution. Okay, so here we have our main products. We have A, is it A and B? We have X and Y. So we have X here and also we have Y here. Okay, so the contribution per unit for X, we have how much? We have 20, then 15. We have 20 for X, then we have 15 for Y. Then how many units do we have? Total units, Total units we have meant for X, we have 20, then 10. 20,000, then 10,000. Okay, then so total contribution. So total contribution, just multiply these ones. Just say the contribution per unit multiplied by the units that we have. So that is our total contribution. Then we do the same thing here. Then this one becomes our total contribution. So in total, we'll be saying the 400,000 plus the 150,000. So 550 is our total contribution. Then we say we divide this by total revenue. And how do we determine our total revenue? Here, for X, we are told that we have 20,000 units, and then the selling price for X is 50. Then for Y, we are told that the units are 10,000, then the selling price per unit is how much is it? 60. So the total revenue will be this much, to just be the 100, which is total revenue for X, plus the Y, the 60,000, the 600, which is total revenue for Y. Okay, so our total revenue will be this much, indicated in blue. So our weighted average contribution margin will be equal to our total contribution divided by our total revenue, which is this one. So this one is always a percentage, so it's 34%. After calculating this one, it becomes simple. What you just need to do is to, I hope you can see. Okay, so that's 34%. Okay, so our break-even point, it will be simple to calculate your break-even point. You just say your fixed costs. Fixed costs in this case, we're told that is 200,000. Our fixed cost is 200,000. Then our weighted average contribution margin, we have calculated it to be calculated it to be 34%. So the break-even point will be equal to the total fixed costs divided by 34%, which is this one. Fixed cost, I think, is 200,000 or 2 million. Okay, so this one becomes our break-even point. Okay, so that is what is shown there. We say in order to calculate the break-even revenue for the next year using the budgeted sales mix, we need the weighted average contribution to sales ratio, which is calculated as total contribution divided by total revenue. So we calculated our total contribution, then we divided it by the total revenue. Okay, so then the break-even point will be the fixed cost divided by that calculated weighted average contribution to sales ratio. So we have 581,819. Okay, so that is basically how you would calculate break-even point for multiple products. What if they're saying calculate the level of activity that is required to attain a net profit of 90,000? What were you going to do? It was going to be simple. You just say the required level of activity you just say is in the formula says is equals fixed cost, then you add fixed cost to the target profit, then you divide everything by the weighted average contribution margin. So that is the formula. So what are you going to do? You're going to say the fixed cost, which is 200,000 plus the required profit, which is 90,000. Let's just put these ones in brackets. Then we divide it by our weighted average contribution margin, which is this one. So this one would become our required level of activity. In this case, it is represented in dollars, because for this one, normally we calculate it in dollars. We can't calculate it in units. So this one is the required level of revenue. If we have the selling price, then we just divide this one by the selling price to find the required level of activity in units. Okay, so if they were we will ask it to calculate in units, we're going to say this one divided by our unit selling price. This one normally we don't actually ask, they don't actually ask as units, because here we have to calculate the average selling price, but then it just can't. You always calculate the break-even point and also those required level of activities for multiple products in terms of dollars. Okay, so do we have questions so far? Or otherwise, I don't have people on the call. Do you have questions? Or are you following? Following. Is it clear? Okay. Okay, that's fine. Okay, so let's quickly go to a comprehensive example. So here we have tested understanding 4. So we are told that BJS Limited produces and sells the following 3 products with X, Y, and Z. Then we are told that the selling price per unit is 16, 20, and 10. Then variable cost per unit is 5, 15, 7. Contribution per unit is 11, 5, 3. Then you buy the sales volume with 50, blah, blah. Then the company expects the fixed cost to be 450 for the coming year. Assume that sales arise throughout the year in a constant mix. Then the requirement is saying calculate the weighted average contribution to sales ratio for the products. Then calculate the break-even point sales required. Then calculate the amount of sales revenue required to generate a profit of 600. Then draw a multiple product profit volume chart, assuming the budget is achieved. Okay, so we are also given the formula for the break-even point. We stressed this formula already. Then also for the required revenue, which is the required profit plus fixed cost divided by the average contribution to sales margin. Okay, so let's start with number A. So number A is requiring us to calculate the weighted average contribution to sales ratio for the products. So it's simple. How many products do we have? We have X, Y, Z. So we have X here, then we have Y here, then we have Z. So contribution per unit, we are told that the contribution per unit is 1153. 11, then 5, then 3. That is contribution per unit. Then our total units, we are told that for X is 50,000, for Y is 10,000, then for Z is 100,000. Okay, so that means our total contribution is equal to the contribution per unit multiplied by the units. Then we drag this formula to this ones. Then also we have to calculate the total, which is the total of the contributions, totals from X, Y, and Z. Okay, so the total will be equal to our 900,000. Then What about the total revenue? Because to calculate the weighted, our requirement is saying calculate the weighted average contribution to sales ratio for the products. We say the formula is total contribution divided by total revenue. So in this case, our total revenue will be equal to, for X, we say the number of units that we budget to sell, then we multiply by the selling price per unit, which is equal to 60. Okay, we do the same thing for Y. Y, we have 10,000 units multiplied by 20. So 10,000 units multiplied by 20. That is our Y. Then our Z, we do the same thing. For Z, we say 100,000 multiplied by 10. 100,000 multiplied by 10. Okay, so the total, we just drag the formula here to give us the total. Okay, so let's indicate the total in green. Okay, so our contribution to sales ratio becomes what? Becomes the total contribution, which is 900,000, divided by the total revenue, which is 2 million. So our total contribution to sales ratio becomes 45%. Let's just highlight this one in this color. Okay, so that was our requirement number 1. Then requirement number 2, it was saying calculate the break-even sales revenue. Okay, so this one is simple. Break-even point in dollars will be equal to our fixed cost. We are told that the fixed costs are budgeted at 450. So 450,000, then we divide by the contribution to sales ratio, this one. So this one becomes our break-even point in dollars, the 1 million. Okay, so this one is requirement number 2. Then requirement number 3 is saying calculate the amount of sales revenue required to generate a profit of 600,000. Okay, so amount of sales revenue required. We just say the formula is fixed cost, which in this case is equal to 450,000. Then we should add the required profit. In this case, we require how much? We require 600,000. Then we divide it by our contribution to sales ratio, the weighted average contribution ratio, sales ratio. So this one becomes our sales required to achieve that level of profit, the 600,000 profit. Okay, so this is how you calculate it. Then the fourth requirement is saying draw a multiple product profit volume chart, assuming the budget is achieved. So this one is important also for you to know, because like that question, you wouldn't be able to interpret it if you don't know how to actually draw this one to say what does it mean? What does that ball-shaped line mean? What does that straight line mean? What is the break-even point? Do we have 2 break-even points here, the A and the B? What does the A mean? What does the B mean? What does that 20 mean? So you can only understand that after you know how to construct the break-even chart for multiple products. So what do you do when constructing a chart for multiple products? Okay, so it's simple. What you need to do, the x-axis, you are going to put cumulative sales. On the y-axis, you are going to put cumulative profit. Okay, so these are the two things that we require. On the x-axis, which is the horizontal line, we put cumulative sales. On the y-axis, which is the vertical line, we put cumulative profits. So the question is, how do you determine these ones? Because here we have three products, and we say in the x-axis we need to put cumulative sales, and on the y-axis we need to put cumulative profit. So if you look at this question, here on the y-axis, we have profit and losses, that is the cumulative profit that we are talking about. Then on the horizontal axis, we have sales, which is the cumulative sales. Okay, so here we have how many products on our question? We have three products, which is X, Y, Z. So what is the first step when you want to show this information on a break-even chart? The first thing is to calculate the contribution to sales ratio for each product. So we're just going to copy some of the information here. So we need this one. Okay, so contribution here, what about the selling price? The selling price is what? The selling price is 16, 20, and 10. So we need 16, 20, and 10. Okay, 16, 20, and 10. So that means the contribution to sales ratio for each product, we are going to say the contribution, which is 11 divided by the selling price, which is this one. Then we drag the formula like this. Then let's express this as in percentages. So after calculating this one, you have to determine a rank order. Rank order. So as you can see, X, this one will be the first one because we have 69% contribution to sales ratio here. Then this one becomes the second one. Then this one becomes the third one. So this is your first step. You calculate the rank order. Okay. Then your second step, before we go to the second step, let me just do some formatting here. Okay. So the second step is to calculate the coordinates that you are going to put on your graph. In this case, the coordinates, our coordinates should be comprised of these ones. On the x-axis, we need the cumulative sales, and on the y-axis, we need the cumulative profit. So what do we do? To be safe, let's calculate first. Here we have our product here. Then second, we have our contribution for each product. Then here we will have our cumulative profit. Here let's put our sales, then cumulative sales. Okay, so it will be able to actually construct this table. Okay, so how many products we have? We have X according to the rank order now, because X is our number one, then number two, then number three. Okay, so X is our number one according to the rank order, this rank order. Then Z is our number two. Then Y is our number three. So the assumption is that we are going to produce these products according to this rank order. Okay, so what is the contribution for X? Before we actually calculate the contribution to X, let's put another line here. So before we produce anything, we already have a loss of 450, which is our fixed costs. So before we produce anything, already we have a loss. of 450,000. When we start to produce X, what is the total contribution from X? Let me put the units here. For X, we have 50,000 units. Y, we have 10,000 units. Then here we have 100,000 units. Okay. So when we start to produce 50,000 units of X, what will be our contribution? Our contribution will be the units, total units, multiplied by the contribution per unit. So our contribution will be 550. Okay. So what will be our cumulative profit? We know that profit is contribution minus fixed cost. So if we say this one plus minus this one, then that means we have a cumulative profit of 100,000. What about the sales? The sales is simple. It's just 5,000 units multiplied by the selling price, which is 16. So our sales will be 800,000, and this also happens to be our cumulative sales. Okay, so here it will be 0, here it will be 0. Okay, then we go number 2. Number 2, we have Z. We are going to produce Z second. What is the contribution from Z? It will be the 100,000 units multiplied by 3, which is the contribution per unit in Z. So we have 300,000 under Z. What will be our cumulative profit is just this one, then we add this one. So our cumulative profit will be 400,000. What is the total sales for Z? It will be the 100,000 units multiplied by the sale price, which is 10. So this one will be the sales for Z. Then what is the accumulative sales? We say this one from X, then plus this one from Z. So our accumulative sales will be 1.8. Okay, then number 3, our last product will be Y. So what will happen to Y? We will say what is the contribution? We say the total units multiplied by the contribution to multiplied by the contribution per unit, which is 5,000. Then what will be the cumulative profit? It will be this one plus this one, which is 450. Then what will be our sales from Y? We say 10,000 units multiplied by 20, which is this one. Then what will be our cumulative sales? It will be the 1.8, then we plus sales from Y. That means we have 2,000. So now we have our coordinates, because we say on the x-axis we have cumulative sales, and on the y-axis we have the cumulative profit. So our coordinates will look like something like this. Our coordinates will be, the first coordinate will be we start with the x-axis, and on the x-axis we have accumulated sales, so it will be 0. Then on the y-axis it will be minus 450. Okay, so this one becomes our first coordinate. Okay, the second coordinate will be simple. It will be our 800, which is cumulative sales. Then on the y-axis, we'll put cumulative profit at this level, it's 100,000. Then the third point will be cumulative sales, that's 1.8 against 300,000. Then cumulative sales, the last coordinate will be 2 million as to how much? 450. This one is not supposed to be 300, should be supposed to be 400. That's the cumulative profit there. Okay, since as once we have these coordinates, then it's very simple to calculate to show this one on a graph. You just plot this one. So let me just see if I am able to plot the graph here. Online graph book. Where do we have here? What do we have? Just hope it will work. Okay, I just hope it will work. So we need to determine the scale here. So what do we have here? Our maximum coordinates we having, because the 2000 represents the x-axis and the cumulative sales. So on the x-axis, the maximum should be 2 million. And on the y-axis, the minimum should be minus 450 and the maximum should be 450. So on our graph here, we need to determine if we start from here, we'll be having 100, 200, 300, 400, 500. What about on this other side? It will be 0, 100, 200, 300, 400. Okay, so let's start here. So this one will be a 0. This one will be a minus 100K. This one will be a minus 200K. Then this one will be minus 300K. Then this one will be minus 400K. And this one will be minus 500K. On the upper side, we have 100, 200, 300. Unfortunately, our graph won't fit here. Okay, if we choose a different, which will be possible, 200, we say 200, 300, 200, 400. Yes, maybe if we choose a different, but it's not fitting. Okay, let's start again. Here we have 0, then we have 200K, then we have 400K, then we have 500K, then 600K. Let's just end there. Then here we have minus 100K, minus 200K, minus 400K, then minus 500K. I think this one will work this time. Okay, so where is our x-axis? Our x-axis is here. Then where is our y-axis? Our y-axis is here. So what do we say we are constructing on the x-axis? It will be just our cumulative profit. Then on the y-axis, our cumulative sales. Okay, so here our maximum is 2 million. We have how many things here? 1, 2, 3, 4, 5, 6, 7. So let's try what? Let's try 300K. Then we have 600K. Then we have 900K. Then we have 1.2 million. Then we have 1.5 million. Then we have 1.8 million. Then we have 2 million. Okay, so now we have a scale. So where do we start? The first point, we just construct our first coordinates, this one. When level of activity is 0, or when the cumulative sales is 0, we have a loss of 450. That's why we needed this point, 450 and 0. So 450, 0 and 450 actually. So 0 is higher, then 450 is where is it? 450 is between 400 and 500, so it's somewhere here. That is where we are. That's the first coordinate. Then the second coordinate is our 800 cumulative sales and 100 cumulative profit. So where do we go now? It's 800 and 100. Our 800 is where is 800? Yes, 800 is here between 600 and 900. 600 and 900, maybe 800, maybe here. So that is where our 800 is. Then 800 and 100. Where do we find 100? 100 is here. So it will be somewhere from here. So we join these ones. So that is where 800 is and where the 100 is. 800 representing our cumulative sales and 100 representing our cumulative profit. Next is what? Next is our 1.8 and 400. This one is simple to read. 1.8 is here and 400 is here. So it's simple. We just join here. Then lastly, we have 2 and 450. Lastly, we have 2 and 450. 450 will be between 500 and 400. Then 2 here. So it's simple. It's just here. Just this, our scale is not really up to standard. Okay, so what do we do now? After drawing this line, you have to join the last coordinate here. You have to join it to the first coordinate. Okay. So after doing this, you are done with your break-even chart for multiple products. So what does it mean? Here, this one represents our break-even point, assuming a constant sales mix. Okay, so if we are selling our products according to that predetermined sales mix, this would be our break-even point. This one where I am putting my cursor. Okay, what if what about this point? Because we seem it seems as if the horizontal line is being crossed by two lines here at different points. What does it mean? This one represents a possible break-even point, assuming assuming the mix is the predetermined mix is changed. So if we go back to our question here, the question was saying we had the same thing here. We had this chart, and the question is saying explain the meaning of the value shown as points A and points B. So point A is that possible break-even point if the actual mix is changed. Okay, then point B is our break-even point, assuming a constant source mix or a constant predetermined source mix. So that is how you were supposed to interpret this graph. Okay, I think that was quite clear on how I was constructing. It doesn't necessarily mean that this one they will say construct. It's highly unlikely that they will say construct. But if you know whatever that is depicted on the chart, then you can answer the question. And then do we have questions on that one? On the chart, the multi-product chart, break-even chart. Do you have questions? Oh, I'm now on my own. Okay, do we have questions? Hey. Hello? Super clear. Okay, what about the others? Is it super clear to everyone? Panache? Okay, that's fine. So, if you don't have questions, I think that's it about break-even cost volume profit analysis. Sometimes, though, also this one is always if they are going to ask about break-even point, the assumptions you have to know the assumptions. The assumptions becomes the limitations because they really those assumptions they limit the precision and reliability of our analysis. So we have 11 assumptions. If you can just produce 2, 3, or 5, you'll be good to go. But as you were seeing when we were doing these calculations, you could see that we were assuming that um, the total cost is only comprised of fixed and variable, or can be categorized as fixed or variable. But you know, in real life, we know that sometimes we'll be having semi-variable costs. So that is a limitation, one. Then it also assumes that the only cost driver or the revenue driver is the level of output. That's another problem. Then it also assumes that the selling price will not change, but it's unlikely that the profit will not, the selling price will not change. They will actually change. It also assumes that efficiency and productivity are to be unchanged. The assumptions in general, they are not really good assumptions. And the assumptions, you can just convert them into limitations. Okay, that is on it on break-even point. Let me see the remainder of the question. What was it asking? Further investigation into the nature of fixed costs has shown that some of those shown in the original budget are incurred as a direct result of providing specific services. Service B, we're 400, blah, blah. I think we, okay, with this information here. Then it's saying evaluate the financial viability of each of the 4 services currently provided. That one is just calculating. It just this in this case you need those absorption versus marginal costing skills. But it was as you can see, number E is comment on any limitation of using break-even analysis for decision making. That question is always there whenever you have a cost profit volume analysis, and that is exactly what I was talking about. Then calculate the overall break-even sales value for the operating plan you have recommended in stating clearly the assumptions on your calculations. So I think I once answered this question from someone. Let me see what I was doing. I don't want to waste time doing the question because I think I once answered it. But from this one, you just need to flex your brain in an examination. So you see the nature of the question. They will not really require you to draw the graph, but if you just have that overview, you'll be good to go. Okay, maybe in terms of income taxes, if you have, if it happens that the question includes income taxes, okay, let me first do this one first. So this one was the solution. I think someone sent this question to me, then I provide the solution. So the explain the meaning of the values shown as points A, we discussed about this one. I said point B represents the break-even point. Then point A is the break-even point that can also be achieved at lower levels of output. Point A represents a possible break-even point, provided that the proportions or the mix of the products are changed. Then question B was saying, after this information, it was saying, evaluate the financial viability of each of the 4 services currently provided. With how many service B, C, D, and E. So I had to do these calculations. So we had service B, service C, service D, and service E. So as the introduction to whatever I was doing there, because this was freestyling, isn't it? It was just saying, evaluate the financial viability of each of the 4 services. So this one was freestyle. You could do whatever. Oh, my time is running out. Okay, that's fine. You could do whatever method that you want, but for me, I had to put my assumptions first or my key notes, my important notes before doing the evaluation. So I said the viability of a product is seen in its ability to make profits or at least a positive contribution on its own. If the product is making a loss or a negative contribution, then it should be discontinued. In coming up with the contribution, only unavoidable this was supposed to be only avoidable costs that are incurred as a consequence of producing that product should be considered. This includes variable costs and those fixed costs that can be traced to a particular product. General fixed costs are not considered. So this is how you could actually answer the question, because if you don't put those important notes, the lecturer won't know whatever you are doing. Okay, so after giving those important notes, then I calculated the contribution for each product. So for products, say we had 8,000 sales and blah blah. Then an avoidable cost. This was supposed to be avoidable costs. I put this one, and then it was found that the contribution was negative for service D. Not really the contribution. That profit after taking into account avoidable cost was found to be negative 1450. So what was the recommendation after this evaluation? Therefore, service D is not viable and discontinuation of the product line can be suggested. However, the continuation of the product is necessary as to avoid the significant financial penalties. I think it was said Zokel Limited entered into a 3-year contract in June 2016, which requires it to provide 500 units of service D per year or suffer significant financial penalties. These services are included in the budget demand. So it was not possible to actually discontinue the service D, even though it was making a negative contribution, because it was the continuation of which was in terms of a contract. So this is how you would think it in an examination situation. Okay. Then, so I said this can be achieved by producing only those 500 units required, and the results will be as follows. So after just producing the required 500, the loss was only 500 as opposed to this 1.4 when we were producing everything according to the budget. This will cumulatively lead to an overall profit of this one. Then the overall profit revised was 17 point something as opposed to the 16 that we had when we were producing the products from D as initially budgeted. Okay, so this is how we will do it. Then what was 4D? 4D was saying calculate the overall break-even sales value for the operating plan you have recommended in part 2, stating clearly the assumptions made in your calculations. So here I was now calculating the break-even sales value. So it was simple. You know the break-even point, you just say fixed cost divided by weighted average contribution sales ratio when you are dealing with multiple products. So I had to calculate my total contributions here, which was this line, then my total sales here, then I divided these two to have 37%. That was the weighted average contribution ratio. Then divide it by the fixed costs. Then the break-even point was found to be 54030.74. The assumptions that I made there was a constant mix between the products. And that was it. That is how you were supposed to answer question number, the last question on 2019 paper. I think that question was sent today by, who was it? Someone sent it today. So this is how you would actually do question number 4. Okay, so do we have questions before we call it a day?